Hello everyone, welcome back for part two of our discussion of the tax equation, and we're picking up where we left off. We have determined our dependents, and now we are looking at revisiting the concept of the standard deduction. Remember when we were talking about it in chapter 1, it was the only permissible deduction. Currently, it still is the only permissible deduction. We've just added some, you might say, complexity to how to determine the standard deduction. We will get into in chapter 3 actual other deductions that would be included in our calculations. But for now, our challenge is to determine how much the standard deduction actually is. So we introduced the idea that there were two single and married filing jointly amounts, but now we have covered the full filing statuses that we have, and that also determines how much our standard deduction is. So we also have a head of household standard deduction to go along with the amount for a single, married filing jointly, married filing separately, and as we talked about, qualifying widower being the same as married filing jointly. That is listed as well as the same amount. But that's not the end of it. All right? So we need to make sure that once we've calculated that basic standard deduction, we also consider the possibility of an additional standard deduction that gets added on top. This is available for those who are 65 or older, or if they are considered blind under the tax law. Okay? That's an additional standard deduction, right? And we'll give you the amounts on the next slide. So that's one special situation. The other special situation is if you're, as a taxpayer, can be claimed as a dependent. So remember the whole idea of being a dependent, okay? That affects the person who is claimed as a dependent as well. So if I am claimed as a dependent on another person's tax return, even though I have to file a separate tax return because I have my own income, and we don't add my income in with the other tax return, we simply have this rule that says my standard deduction is limited to the higher amount, either $1,100 or my earned income plus $350. The $350 is for interest you might earn on top of your regular earnings. So if I have a job and I make $2,000 and I'm a dependent on someone else's tax return, then my standard deduction would be the $2,000 I earned plus the $350, but never more than $12,550. So if your earned income is higher, it keeps, is higher than, it's like 12,000 something, then you're going to use, you're never going to have, you can never have this combination of earned income plus 350 be more than 12,550. So 12,550 is the maximum standard deduction you could have. So most of the time, this is for those with low income amounts, kids, that sort of thing, and therefore that it is not an issue with the full, standard deduction for a single individual. Now, how much extra do you get? This is on top of your standard deduction that we gave on the earlier slide. If you are 65 or older or blind, okay, you get, if you're single, then you have the $12,550, and then you have $1,700 extra if you're over 65 or you're blind. So you'd add that to the 12,550. If you're married filing jointly, if you're one of the two people filing jointly, because you're married and you're over 65, then you get an additional $1,350 on top of the standard deduction for the married filing jointly. And then we have to look at the other spouse, okay, that's filing jointly as well, to see if they happen to be over 65 or blind. Now, you can get it for both. So if you are, for instance, single, over 65, and blind, you would get the standard deduction. You get the $1,700 for being over 65, and another $1,700 on top of that for being blind. Okay, so but then you're done. Okay, as far as extra standard deduction. Marital filing jointly, you could have each spouse could be over 65 and blind, and so you would have the $25,100 for the standard deduction, the basic standard deduction, and then you'd have $1,350, two of them for the spouse one that is over 65 and blind, and $1,350 added on for the other spouse who is over 65 and blind. That's your maximum that could happen. All right. So notice that the amount of extra is entirely based on marital status. Okay. If you're single, okay, and remember, head of household, it has to be single. Single or head of household, $1,700. Married filing jointly, married filing separately, and qualifying widow or being treated like they are married, okay, is $1,350. So once we've subtracted those standard deduction with any additional that we might need, in Chapter 5 we'll learn that we also could itemize deductions, but we always do either the standard deduction or the itemized deduction, whichever is highest. Now, that's important to remember. Once we subtracted the higher of those two, and right now that's only the standard deduction we'll consider, okay, then we have our taxable income, and we can calculate our tax liability. Remember, we talked about that in Chapter 1, that if it's under $100,000, okay, then we do it on the tax tables. If it's over $100,000, we do it on the tax rate tables. And then any tax payments or credits reduce the tax liability. All right, and we kind of are just giving you a little teaser about some of these tax credits until we get to Chapter 9, when we'll go through all of that. Well, not all of them by any stretch, but the most of them, a good chunk of the ones that you would run into most often. So a new one that was added for 2021, child tax credit for 2021. Well, it already existed. It was increased. That's what I should say. For 2021, the refundable part, it updated this child tax credit. It used to be $2,000 per qualifying child. And for 2021, it's $3,600 for children, for qualifying child under 6, $3,000 for qualifying children between 6 and 17. And just to make our life more complicated, there are two phase outs of that. Meaning, if your income is up to over $75,000, if you're single, the new tax part of the new tax credit, the extra $1,000 or $1,600 starts to phase out. The rest of the $2,000 tax credit, child tax credit, doesn't start to phase out until $200,000. So you've got now really two phase outs just to make life more complicated in that regard. All right, so again, another change to the tax law that is going to be in place for 2021. Most people have already received that credit. It was sent out in the form of prepayments throughout 2021. And so most people are not going to be, are not going to get any more, if you will. They will just have to reconcile to see if they are entitled to more or less than that at the end of the year based on their tax situation. There is a non-refundable dependent credit, if you will, that's often talked about at the same time. It's only $500 for those that are dependents but don't qualify for this child tax credit. So if you're 18, for instance, then you don't fit under the refundable. You could still be eligible for a $500 dependent credit. So then, of course, as we talked about before, you calculate how much you've paid in, how much your credits are compared to what your tax liability is. Okay, if you have additional tax liability, you got to send in payments. If you have more credits and payments than liability, then you get a refund. Now, if you happen to need to pay in, okay, then, or you have, the IRS finds that you owe them more money through an audit or something after the fact, they can charge you interest on the fact that you didn't pay that when you were supposed to. And that is, here's the rates. It's changes based on what the rates are in the economy. All right, and this is on top of what tax you owe. You owe interest to the government for, as they see it, keeping their money longer than you should have. Other penalties to try to encourage everyone to send in their returns, pay the taxes on time, all that good stuff. There is a penalty for a failure to file your tax return. For every month or fraction of a month you don't file, it's 5%, can't go more than 25%. So after 5 months, right? However, if you go over 60 days, no matter what the situation is, that penalty can't be, all right, the lesser of 435 or the amount of tax required on the return. Now, what's interesting there is you see that still is based on how much tax you owe. So if you don't owe anything, if you're getting a refund, which now you're hurting yourself by not paying, sending in a tax return and claiming that refund, but you're not going to get charged a penalty if you have a refund on that return, even if you're slow in paying in. in filing it. There's also really no reason to have this penalty, because even if you can't meet the deadline of April 15th, you get an automatic extension just by filing for it, just asking for it, sending a form. It gets you all the way till September to file that. So, till October. So it plenty of time if you just do that. What people don't understand is that extension does not give you more time to pay. It simply gets rid of this penalty for sending in your tax return late. Now, if you miss the October deadline, now you've got a bigger, now there's nothing we can do about it. We've got this penalty if you owe again. Notice that the failure to pay penalty is only 0.5% per month. So it's more like interest. That's 6% per year. Again, not going to be more than 25%. So a lot less onerous than not filing your return on time. So really, if you got a challenge, you want to make sure at least you get the tax return filed on time, because even if you don't pay in, the penalty for not paying in what you owe is so much lower than not filing. So it's never a good idea to just ignore sending in your tax return. If you didn't send it in and don't pay, okay, then the maximum is 5% per month. So we don't tack it on. It doesn't become 5.5%. It just kind of gets sucked into, they both get kind of mushed together, and the maximum is still 5% per month. Now, most of us have regular jobs and we get money taken out of our check to pay our taxes all along, and that's reported on the W-2. We're actually making estimated payments. We don't know what our tax liability is going to be, but we tell our employer that they are going to estimate how much we're going to owe and take it out of our check each 2 weeks, okay, or every month, or whatever time period you're paid on. So that's estimated payments. Now, if you don't have a regular job like that with an employer that's withholding, if you're doing gig type work, or you have your own business or something like that, then you need to the government is not going to just wait till the end of the year when you know what your taxes, what your income is, to send in your taxes. You're going to have to make estimated payments. Okay? The same way as somebody that works a W-2. And the rule is you need to pay in at least 90% of the current year, and this is to avoid any penalty. If you don't do this, you're going to get charged a penalty, basically interest on the money you should have sent in. 90% of the current year's tax, or 100% of last year's tax. So if you say, I don't know what I'm going to owe this year, I don't know what this year is going to work like, how do I know what to put in? Well, send in 100% of last year's tax. Okay? All right. If it's more than, if your income is over $150,000, it has to be 110% of last year's. They're not going to charge you any penalty if the amount you end up owing after you send some in, and maybe you come up with a pretty close estimate. As long as you get it within $1,000, they're not going to charge you a penalty. Okay? What if you don't you put something down wrong on the tax return? Okay? Some people are very paranoid, and we do want people to voluntarily comply with the tax law, and as tax preparers, we have some responsibility in trying to get them to help them do that and send in the correct information. But what if we make a mistake? First of all, for the most part, no one goes to jail for making a mistake on their taxes, even serious mistakes. All right, but there is penalties if there is a mistake and they audit you and you realize there's a mistake. Okay, you have the penalty is 20% of the tax due. So that's on top of what tax they come up with that you owe in addition to what you originally owed. If they consider it to be fraud, that's more intentional. Okay, now we're starting to talk. This isn't a mistake. Mistakes are not fraud. Okay, fraud is when we intended, we knew it was wrong and we sent it in anyway. We intended to pay a lot less than what we could be subject to penalty up to 75% of the amount we owe. Okay, if we send in a claim for a refund with wrong information on it, we could get dinged on this side. So remember, the other ones are based on the tax that is due, right? Well, what if you don't owe anything? Can there be a problem on the refund side if you don't owe it? You claim for a refund and it's found to be wrong, you could lose 20% of the refund that is actually supposed to be there. Okay? All right, so that's, or the 20% of the refund you received in error. Okay, they sent you that you didn't deserve.